All right, everybody, welcome back. We're going to get CPI today only because of COLA, cost of living adjustment. But the why doesn't matter, just the fact that we're going to get it. There's been a lot of speculation about QRA. And if you're new to all of this, that's one of those quarterly events that you never really hear about. It doesn't show up on your regular calendar. Um, you don't see a lot of posts about it, but it has a lot of impact and it's coming up soon. Now, QRA has two parts. There's a Monday piece that comes in at like 3 o'clock in the afternoon, 2 or 3, I think it's 3. And then on the following Wednesday, we get the other part of it at 8:30 in the morning. And that Wednesday, a lot of times, is also an FOMC Wednesday, which is how it's always easy to remember that the first one is in the afternoon and the second one is in the mornings. The second one can't be in the afternoons because it would conflict with FOMC in the afternoon. The only reason I'm able to keep those two separate. But it's right around the corner. I think it's the first week of November. So I believe, and I'll check my notes to make sure, but I believe we'll get the first piece on the 3rd and the second piece on the 5th. With that in mind, if we kind of see what Goldman Sachs is chipping their teeth about with quantitative tightening and the upcoming FOMC event, if they do make changes to the rebalancing or the quarterly funding, that could have some wide-reaching implications. This, for an example, where the purple line is, or the pink line, that is previous QRA events. And we can adjust that a little bit, look back a few years. A lot of times, they don't make any changes, right? They just say, we're going to continue to do what we have been doing. And so no changes are made, and price just continues to do what price was already doing. But when they do go in and make significant changes to QRA, that can line up with significant changes in market structure. It can flatten us out after having a really nice run, or it can start sending us to the downside. Here's another really good example where we were trying to come back up out of this mess, and QRA sent us right back down again. So it's kind of a big deal, right? And it's not just some one-off headline and then we're done. It has far-reaching implications. Now, Yellen used to handle all of this, right? And Yellen's gone, and her replacement has been just staying on her playbook. What she was doing, he just continued to roll it forward. He didn't make any changes. So if we do see changes, it'll be the first time that he's been able to stir the pot. And, probably won't have any issues, but it's worth considering what if. So one thing to consider is that the next few weeks are going to be very hostile, likely very volatile. We got a lot of things coming. And what's the old phrase? Know what you own? With this much risk on the horizon, you really want to be mindful of the gains that you may have this year and whether or not you want to see a 30% cut in all of that. Maybe a little more, maybe a little less. And it doesn't have to go down, right? I know it's easiest to talk about volatility and uncertainty as sending the market lower, but it doesn't have to. And I want to keep pounding the table on that. because we've seen it all year. Keep everybody just slightly negative, keep them off balance, keep them in uncertainty so that they'll just keep adding to those shorts and those shorts just get overrun. And we need those shorts for the market to continue to go higher. I know that might not make a lot of sense to newer traders, but we need those shorts, right? So it's easy to just point to the downside and say, oh, yeah, all of this volatility leads to negativity and that the market has to go down or is at risk of going down. But it's a two-way street. I want to just keep reminding people of that. What we're looking at right now is the FedWatch tool. Anybody can go here. It's free. It doesn't cost you anything. I'm not logged in. You don't need an account. Just go to Google and type in FedWatch, and you'll find the CME group page here. There's other places you can see this, by the way, but it doesn't matter where you get it. Just have a place where you can see, one, when is FOMC going to happen? And two, what are the projections for FOMC? So I use this one. You can change the dates at the top, and it'll not only give you the probabilities up at the top of where we are right this minute, which is just a snapshot. It'll also give you some clue as to, well, where have we been? This is where we are now. This is where we were yesterday, where we were a week ago, and where we were a month ago. That way, when you hear people say, oh, that was already priced in, and you're thinking, how the heck do you know that? Because of this data. Or if they say, yeah, that's getting priced in today, they're doing blah, blah, blah. How do you know that? Because of this data. I believe the projection right now is that there will be 2 rate cuts by the end of the year, quarter basis point each. If you're having a hard time reading this because there's 2 numbers here and 2 numbers here, just pick one, right? Don't make it complicated on yourself. If you pick the front one here, pick the front one here. And if you pick the back one here, then pick the back one here. Just make it that easy, right? So if we're at 4 1/4 and there's a 97% chance that we get a 25 basis point rate cut, we'll go from 4 1/4 to 4. That would be for the October 29 FOMC event. And then December 10, we can see it's at 375. Well, they're not talking about a 50 basis point rate cut in December going from 425 to 375. Instead, they're more leaning on the idea that we would get 25 basis points in October and another 25 in December, which would put us at 375 by the end of the December meeting, right? So that's the probability right now, 90% chance that we'll be at 375 or that we would see a 50 basis point reduction between now and the end of the year. Whether we get 50 in one meeting or 25 in 2 meetings, that's the anticipation. Just keep in mind that the October 29 FOMC is the week before QRA this time. It doesn't always happen that way. Sometimes QRA and FOMC land on top of each other. And that's if I got the dates right. I still need to check. QRA could be a week early, and it could end up in October this time. I don't think it is, but until I check, and I might have already put it on here, so let's just take a peek. Now it's on the 5th. So, okay, yep, November 5. It'll be 1 week after FOMC. For today, we're going to get CPI only because they need the cost of living adjustments, right? The COLA. If it wasn't for that, we would not be getting CPI. And they had to call the crew in because they were furloughed or laid off, or pick whatever word you want to use. They weren't at work, and they had to call them into work just to get that done. This is timely because yesterday we were just talking about big event bars. These event bars, I like to call them liquidity bars, offer a liquidity gap. I'm a little bit picky about this particular trade. So if it doesn't give me the setup for a trade, I'll show you how we can still use that bar for the rest of the trading day anyways. So this is a CPI event. I call this a liquidity gap. If I'm going to trade the gap, I don't want any wick going in the opposite direction. In this case, it was a bullish bar. There's no tail on the bottom of this bar. We got the news and it went straight up. We closed in the upper 25%. So if you was to mark a candle out and cut it into quarters, 50%, 75%, 25% down here, we closed in that upper 25%. I like that. I want that. After we get that bar closed, we're looking for it to come back down to where it started because we're looking to close the gap. Now, it doesn't have to close the gap, right? Price can do whatever it wants. But that's the idea. Generally speaking, it gets the gap closed around 10:30 or 11 o'clock. Now, in this particular example, the gap didn't get closed. We digested up here and we ran higher. Once we get this 5-minute bar, and that's what I use as a 5-minute bar for my drawings and analysis, you can cut that thing up with your drawing tool, mark the midpoint, and then you can project higher 50% and 100%. And of course, you can project lower too, because if we happen to have gone that direction, the levels would work that way as well. So it's not the 111 and the 1236, although you can have them on there. That's what this hit. But you want the mid and you want 100% more, because those are out of the textbooks. There's so much liquidity that comes into a liquidity bar that it can just punch right through 111 and 1236. So you want those bigger numbers, the half and the whole. And on the fade back, a lot of times that's what we bounce off of, is that half. So you want to mark that. So this one didn't close, but this one did. It's another really good example. No tail on the bottom. It closed in the upper 25%. This one really didn't digest that much. It had the straight shot, and then it got back down here between 10:30 and 11 o'clock. On the overshoot, by the way, if we had measured all of this and projected 50% to the downside, yeah, that's what we turned around at. Don't you love how that stuff works? Same thing here to the downside. 8:30, we get news, get a big liquidity gap. We spent a little time digesting. We got back to the gap close between 10:30 and 11 o'clock-ish. Here's another really good example, also a CPI day. Now this one, it didn't make just one shot. It ran up and then paused, and the second candle stayed in that 75% range. Then we continued on, digested, worked our way back, got there between 10:30 and 11 o'clock. Ain't that cool? Why I keep saying, watch the clock. There's so much value in the clock. It's one of your best indicators, and it's free. So here's a CPI day print where we got big wicks on each side. Look, there's no gap to close if we open and close in the same spot, right? So it's not a gap. There is no gap. We're right back where we started, but you can still use this bar. So mark out the midpoint, measure above and below 50% and 100%. And that way, when we go higher, that's what we hit up here, by the way, that day. We kept hitting 50% of this bar. If we fade back and go to the mid, then we could see a response there. Here's another example. This is not what we want for a gap close play, right? Because we opened and we closed really close to the same spot. We had wicks going in the wrong direction. None of that's what we want. but you can still use that bar. Measure it by 50% and 100%, mark the midpoint of that bar. It will be useful and relevant to you later. Same thing again here, right? So I like to have examples of ones that worked, ones that didn't work, which is what this one was. We never closed at all. And then ones that we wouldn't want to use necessarily for a gap close, but we could still use it for analysis. I have found over the years that if I take pictures of the strategies that I want to trade, it gives me an opportunity to examine them in better detail. What they look like when they work, when they don't work, when the setup is great, when the setup is really bad. If you don't know what your trade looks like, how are you supposed to find it? How are you supposed to trade it? So we have this opportunity today at 8:30. It's like knowing when lightning is going to strike, right? Are we guaranteed to get a really big bar? Nope. Price could do whatever it wants, and theoretically speaking, at 8:30 we could just not see a big bar at all. I find that really hard to believe, but it is possible, right? It may not be probable, but it's possible. So we got to see what happens. And there's no reason to guess or assume that we know if it's going to go up or down with the announcement. I know that's one thing that a lot of newer traders generally ask. What direction do we think it's going to go? I don't have a clue if it's going to go up or down. And most people don't either, even if they say they do. The news could be positive and we can go down. The news could be negative and we could go up. The news could be good and we can go up. There is absolutely no way to tell. So we just have to let it go. A lot of times, though, you will see Goldman or JP Morgan give some projections. They'll say if the data was within this number and this number, we should go higher by 1%, 2%. But they don't mean at the moment of the announcement. They mean through the rest of the trading day. And on that, yeah, I can see how that's useful. But don't try to second guess what the event news will be. If you want to trade it at 8:30, use something like the parachute play that we developed in Trump's first term. That strategy works pretty good on event bars. So otherwise, the US markets are slightly green. Everybody else is slightly red. The only ones that are heavily red, Canada down more than 0.5%, and that's not really all that heavy. You know, 0.5% ain't much. Small caps up 0.5, with Canada down 0.5, and everything else just wobbling around in the middle. We're just waiting on data. So when it comes to data right now, make sure you're looking at stuff that tells you whether or not it will actually be announced. Because of the government shutdown, we're not getting a lot of the data that we typically would. So if you're using different sites, make sure that they've got some sort of tell that lets you know whether we should or shouldn't get the news. New home sales, we will not get the news because it's temporarily suspended because of the government shutdown. This one, with the two little asterisks right there, on all of these, we will get it because we need it for COLA. Simple enough. If you look at the numbers, they're not expected to be that far off. So, you know, I think everybody's got a consensus that this is just supposed to be a continuation of the previous numbers and no real change. There's some danger in that because if we actually do see change of size, then a lot of people are going to be on the wrong side of the trade and we could get some nasty volatility. We got some sentiment tells at 10. I was trying to do a little bit of research yesterday on the possibility of getting a downgrade. And to me, that's still one of the biggest looming threats. And it's it's in the palm of somebody's hand, right? Because the people who work there that can put out a statement that says we're going to downgrade, they can do that whenever they want. Whether it's politically motivated or whatever, if they want to announce a downgrade, to the credit, they can, because there's multiple agencies out there that do credit ratings. That would hit us really hard. And if they get fed up enough, they can do that. All right, with the president traveling, don't think we're going to get anything from him. So a little bit of a blackout period when it comes to the afternoon White House shenanigans. And if you look at CTA positioning, this white line is the SPX, the green line is CTA positioning. We've run back up to that fateful Friday's high. Well, that's a tongue twister. But CTAs did not reposition back into it, right? So that by itself is not enough to warrant any activity, but it should be on your radar, right? Same thing happened back here, by the way, when we had this sell off here and then the markets ran right back up and went even higher from there. CTAs really just sat the heck out. I mean, they kind of dabbled a little bit, but nothing compared to what we did in the market, right? We matched the previous high and then we expanded more than 100% more than the pullback. They didn't even make it back up to the midpoint until we were reaching over 100% of that pullback. So don't let this make you think that we have to go down from here or anything like that. And it is another example that, these quote smart money, it's not smart at all. They just have more data than you, and they have more man hours and manpower to peruse that data than you do. That's it. That doesn't make them smarter than us. They just have more people going through the data than us. So I'm going to post this in a little bit. Obviously, I didn't write it. I don't want anybody thinking that I'm taking credit for this when it does get posted. It's Goldman Sachs' take on QT. And I highly recommend you to put this into your favorite AI machine and have it translate it into something that you can understand, right? Because it is important. The call wall rolled back down to the level it was at earlier when it rolled down this week. It didn't go lower than that. So the call wall is like just moving in a wave. You can see it's back to 68.36. So it's been bumping up here, down here, bumping up there, down here. That's all it's doing. As long as it remains at that level and it doesn't get lower than that, we'll just let bygones be bygones. If it rolls any lower than that towards this range that we're in, I'm going to read that as aggressive negative bias. But we don't have it, so we don't need to worry about it yet. Volatility trigger and zero gamma still below us. We have to get through the 3 and the 10 to get there. Underneath zero gamma, we got the 20 period, and then we have the 3-week moving average. So we got a lot of structure underneath us if we do fall to the downside. We're 60 points away from zero gamma. So, we're fine. It's a long ways off. We got a really nice tight consolidation up here right underneath 6,800. We could see 6,800 highlighted there. So consider it front running. They're hitting it before it gets there. But we're putting in higher highs. Even if we are just wicking higher, we're putting in higher highs. Here's a really good example of reciprocation, by the way. What you get on the top, you get on the bottom. Reciprocation, like a jigsaw. The problem is after we got back up here again, we didn't come back down here again. So it didn't last. If it had lasted, I've been calling this the zipper pattern. If it just does this back and forth through VWAP, I've got a lot of research on that. I'm not ready to publish the data, but yeah, the zipper pattern. But we don't have the zipper. It broke. We're still on the upper edge. We'll see what happens next. If we can get through that 6,800 and close above it, that'd be awesome, because then we can use it as structure and it'll be underneath us. The problem is we got to get above it first, one thing at a time, right? Put it all on the daily for a moment, and it is this range that we've been in. A lot of markets are still inside this range. Yesterday we were talking about, I think it was Amazon we were talking about, is still inside this range. There's a lot of markets that are stuck inside of that 5 minute or this Friday candle. GTFO, right? You have to get out of that box if you're going to get anything else done. So if you're looking at Meta, Amazon, Google, whatever it is, if it's in that box, you got to get out of the box. Otherwise, what's your trade to get to the edge? Anything beyond that is just a trip to Vegas. Looking at 64,000 in the overnight. I'm surprised at the volume, honestly. With this being CPI day and everybody know it's coming, I kind of expected that they were going to sit out a little bit, and not participate and wait on data. But the data is supposed to just be the same old, same old. So maybe that is reinforcing the idea that the numbers are not supposed to be far apart. They're supposed to be the same old numbers that we had last time, and that there hasn't been any real change. But that calls BS on that theory. If the numbers are supposed to be the same old numbers and nobody's worried, why are they spending money to hedge? Now, they're always hedged. Don't get me wrong. They are always hedged. This is additional hedging, and hedging is nothing but cost. Start a fire, take your money, and throw it in the fire. You're not getting it back, right? That's a hedge. They are spending money on a hedge today in front of CPI because they're worried. If they're worried, that means they expect the possibility of violence in the price action today. I am making an assumption that this hedge is because of CPI. That's a pretty fair assumption, all things considered, but it doesn't have to be. So after 8:30, we want to see this number begin to decrease, and that will prove the theory correct. If it doesn't, if we get past 8:30 and we get into 9 and 9:30 and this number is staying elevated or is growing bigger, then we were wrong. I was wrong. It wasn't CPI. They're hedging because of something else. If you haven't seen this label before, it's a think or swim thing. It exists here because they made it up. There's the tag for it, marker maker move. And that is what they call when you get the front end implied volatility, this number, which goes to the 0 day. When that number is greater than the next number out, which is this one, happens to be Monday. If the front one is higher than the back one, you get a market maker move. That's how it works. So if your platform is not think or swim and you want to know if we have a market maker move, just go look at the implied volatility average on the options chain and look at the front end. You might not know the size of it, but you can just do the math. How far apart are these two? And you can use the dollar values here. You don't need to use the percentages. That differential is good enough, right? Just subtract them from each other, and that's your market maker move differential. The average daily range is 80 points. You can add this 30 points from the market maker move to that, and that gives us 110 points in a single direction. And we would not be considered overbought or oversold or even extended at that point. So we can go 110 points, and that's just another day in the park. Add 50% of that and it would still be a normal day. So now we're looking at what, 165-ish? If we double the number, things are going to be a little extreme at that point. That would be 220. So if we move 220 points in a single direction today, we would at that point begin to see the edges of what extreme looks like. It doesn't sound like much, right? 220 points. Otherwise, the lower ADR half is inside of yesterday's trading. We can easily hit that. Or if we keep the inside day breakout that we've already managed to accomplish, we can get to this upper ADR half. At this point, hitting the upper one is going to be easier than hitting the lower one, because to hit the lower one, we'd have to break back inside of Thursday's range and then get through Thursday's midpoint just to get down and hit that. Don't get me wrong, neither one of these are going to be helpful until after CPI, because we could just stay tightly wound in this little bitty box that we have right here until 8:30, and then we could explode in both directions and hit both of those things before 8:35 is done. So that's not going to be helpful. But after CPI, once the big bar violence is done, then we want to see where we're at and if we're closer to one edge or the other. The closer we are to one side, that's the one we're more likely to go tag. But we got to get through the event first and see what the bar looks like. It could end up being a bar that looks a lot like this, right? This big red tail here. And if that's the case, we're going to be basically right back where we started again by 8:35. And we would be closer to the upper one than the lower one. Central pivot ranges, or CPRs, are not going to be helpful at this point. We've got to get through the range first. That's not the one we want. There we go. We got to get through data first before we do anything else. Today's channel is wide. That implies that breakouts won't stick. Today's pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. And we are inside day breakout. So to get down to this missed daily pivot, we'd have to break back inside of yesterday's range, break the channel, and then get to the pivot. We can totally do that. I don't want to make it sound like it's impossible, but there's a lot of things in the way, and we got to get through data first. It is a missed daily pivot, but it won't count until the end of the day when we look back and say, hey, we made it all day long without hitting it. Until then, it's just a possible missed daily pivot. If you want to know more about missed daily pivots, the guy that really elevated this concept, he's got videos on YouTube. So it's not my strategy. I don't even trade the strategy, but I do use the strategy for analysis. So it's worth learning, or it's worth understanding, just to have a better idea of how pivot points can help you better analyze the market. Just go Google missed daily pivots, MDP, and find it on YouTube. It's worth your time, I promise. $68.03 is the R1. The concern is that we get an R1 S2. S2 would be 66.92 cog line. That's Wednesday's low. It's a double structure support low. So I like that. If we head to the downside, break floor pivot, S1, then S2 is the target. That's also really close to the weekly pivot. And if we get that close, why not? I mean, I said that before, and we got this close and we didn't do it. But, you know, if we overshoot Wednesday's low, get through S2, that would be the next target. We don't have to go R1, S2. We could close above R1 and work our way up into R2. If you get that close to the cog line, we're likely to go ahead and get there. So that'd be 68.32 cog, right about there. But, that leads us back to why would we? I mean, we've got the breakout. This is the breakout we've been working for all week, right? We've been bumping our heads, and now we're finally getting it. Look at that Busby. Yeah, I love it. Come on, you got it, man. That's a good one. So now we got the Busby, and we're making our move to the upside. But R1 is there. So get through R1, close above it, and we could work on R2. The problem is CPI at 830. If we wick up through R1 simply because of a data print like CPI, then it doesn't count. We have to get up there and stay up there on our own, not because of data print volatility. All right, the profile on the week is a bit of a squished D pattern. Last week's D looks a lot better. That's your classic D shape. This one is not yet a P shape, but it is a bit of this wedge shape. I don't know. In the textbooks, they would still call it a D, even though it's pressed against the upper edge. So it is, as usual, GTFO, we got to get out of the box. You can see the previous week back here, and we're above that point of control. We talked about this yesterday in the live stream. We got to get through this level. And now these two together were significant levels of resistance, and we made it through there. Now that we're above them both, that should act as structure and help us stay up here, as long as CPI doesn't punch through them, right? If we get a violent CPI print and it cuts us through both of those, I don't think we're going to get back through those to the upside very easily. I think once we get back below them, they're going to be significant in resistance again. Ten-day, 30-minute volume profile in TPO, classic D shape. We got some shallow areas. So if we did break 67.60, then we could drop down into that 67.50 area. It's a nice little 10-point play. Then it gets shallow again into, say, the 20s. I don't think those shallow areas are going to benefit you all that much, really. I mean, if this was a daily and it had those shallow areas, I'd say it probably could help you out a little more. But on this time frame, I don't think those are going to really help all that much. But you can see how even TPO got really shallow there. Not necessarily on this one, but on this one, TPO aligns. By Monday, we should have a narrower profile, not by much, but a little narrower. And then throughout next week, if we can make it through the whole week without breaking down into last Friday's low, then we could get a much narrower profile. The problem is if we continue to expand to the upside, we'll still be looking at a stretched profile. It'll just be up here somewhere. All right, we hit 67.92 cog line and this VPOC that's been on here, but we hit it today, so I'm going to leave it on there all day long. Personally, I don't need the line. It's a cog line. I'm already looking at 92. I don't need it. But leaving it on there through the whole day is the accepted practice. It's what I do. So I don't delete the line first thing in the morning because we've hit it first thing in the morning. I leave it on there all day. It's my platform. I'll do what I want. You do you. If you take it off as soon as it got hit, well, do that then. We don't have, I take that back. We do have a new VPOC from yesterday. right underneath us. So there's our new one. It's a little off. I don't use the ticks. If you want to get, that specific with it, you go ahead. I'm just going to use full points, and 74 is close enough for me. So if we do head to the downside, yesterday's point of control is 67.74, and if we break through that, it gets a little shallow. Then it starts to get thick again in front of 67.50, like they're going to front run it a little bit. We got a preview of next week's range. It's only a preview. This range will move all day long with price, and it won't lock into place until after the close today, sometime around like 4:15 or 4:30. So what we do with it is we examine it and measure it against our current week's range. The math behind these ranges is based on the square root of time, how many days, and then options data. Well, next week's a 5-day week. This week was a 5-day week. So the number of days is the same, but next week's range is narrower than the week's range that we just had. Right? We can see I drew the box. I'm not getting it, to the tick perfect because I'm not a Canadian engineer and I'm not going to get all anal about it. That's close enough. Next week's range is a narrower volatility. That implies there's less volatility next week, that the market doesn't see risk next week. But that's misleading and it's false. If there's big calendar events in the next week's session, what the options market does is anticipate a sideways market. FOMC, for an example, is volatility suppressing. I know it is counterintuitive, but it is volatility suppressing. The options market is trading into the idea that sometime between Monday and Tuesday we'll go sideways because a lot of traders won't want to get into new positions right in front of FOMC. And so the lack of movement, what I call the hurry up and wait before big events, means that we have a narrower expected move for the next week. So it's a little bit of a tell that next week is narrower. The market is anticipating a hurry up and wait mode. I'm not anticipating that, by the way. This is what a hurry up and wait mode week looks like. Sideways, waiting on data. But guys, what do you think we did all week? Huh? What do you think we did all week? We played the hurry up and wait mode. Markets get bored like ADHD kids with a lot of Red Bull, right? What do you think? You think we're going to go sideways until next Wednesday? I don't. I think the market's going to get bored. They'll start responding to the slightest move, the lightest breeze, and they're oversensitive with too much Red Bull, and they're just going to make big violent swing moves. So we'll see. But that's the projection, and there's no reason to argue that it is the projection. Whether or not we get it is completely different. Gold miners are down. Mag 7 down volume is down. So we have the capacity for a bullish day today. But again, it all rests on CPI and the market's reaction to CPI. Looking at what's up this morning, we got the Mag 7 up volume quantum, which is because of the White House's statement and Bloomberg calling BS on them. chips, solar, Bitcoin, China. We've got everything we need for a breakout rally day. We could add to this once we get into the regular trading day. If we get 0-day flows that are bullish, if we get moves in the dollar and the 10-year that might help us out and be bullish. But this alone is all we need. Having the Mag 7 and Bitcoin and chips, we're good. We can rally on just that. But it doesn't mean we have to, right? So the fact that we're up this morning is a good start. We got to finish that off. We got to keep it, get through CPI, and continue to go. Normally, we talk about GTFO, right? We start the day, we got to get out of the box before we do anything else. And today is no different. The only thing that we're missing is the size of the box, because what we have now is not what we're going to have in 12 minutes, right? Well, the White House says that's not true. And then Bloomberg said, yes, it is. We have this as proof that it's true. So I would say follow the truth, right? I can't tell you how many times we've seen the government say that we're not doing that, and then they say, oh yeah, no, we're actually doing that. But it's not just the government, right? Quantum does the same thing. Companies do the same thing. They'll say, no, we're not trying to buy X company. I promise we're not buying X company. And then the next day they'll come out and say, oh yeah, by the way, we bought X company. So it was in here. I'm looking for there it is. Quantum computing stocks were in the spotlight. This is yesterday's, right? It's 10:23. So this was last night. Quantum computing stocks were in the spotlight due to a Wall Street Journal report that the administration is considering taking equity stakes in quantum computing companies. The report was later denied by US officials, but a Bloomberg piece regarding possible financial support provided a late boost. So now you know what I know, right? Maybe. Yeah. Truth and politics, those two things are really far apart, right? So that's what we have. Um, we'll go from there. Follow the money. Isn't that what they always say? So we have less than 10 minutes. We're going to get the CPI report. Remember that the very big bar that you get at 8:30 does not have to continue for the rest of the day. And that's one of the reasons I point out this liquidity gap thing. Even if you don't want to trade it, right? So you have no interest in trading it whatsoever. Don't think that just because we have a real big bullish bar at 8:30 that the rest of the day is going to be bullish, because I've got hundreds of examples where it's not true, right? Where we just turned around and we went back down and we closed the gap instead. Or if we're really bearish, that the market's just going to sell off into oblivion for the rest of the day, because once that 8:30 print closes, a lot of times we're going to close the gap. Now, what we could do after the gap is closed, well, that's a completely different discussion. But let's just get through the print, use that 8:30 candle once it's done to lay out our trading ranges and make some money. And then we'll worry about the rest later. So everybody, be careful, be safe, have a good weekend.